Welcome to the Deep Dive. We cut through the noise on complex topics, basically giving you the key insights, a shortcut to being genuinely well-informed. Today, we're tackling something big, a question that's really shaped economic thinking for, over a decade now.
You probably remember the Queen asking after the 2008 crisis, why did no one see it coming? That question and, everything that followed, the recovery efforts, the rethinking, that's our focus. We're diving deep into how policymakers had to fundamentally reevaluate macro policy. We're talking monetary, fiscal, and this newer third leg, macroprudential tools.
Exactly. And for this deep dive, we're drawing heavily on a couple of really key IMF conferences, one in 2011, another in 2013. These brought together the top minds, researchers, policymakers. They really captured that initial feeling, like stepping into a brave new world. Lots of questions back then. But they also tracked the real progress made in theory and practice as everyone wrestled with the fallout. Okay, so our mission for you today, to boil all that down, we want to pull out the core lessons, look at the new tools they came up with, and explore the debates still going on about, keeping the global economy stable. We'll cut through the academic stuff, make it clear, engaging, give you the real picture. All right, let's dive in. Monetary policy first. Before the crisis, things looked, simpler, didn't they?
They did. Central banks often worked with this idea. One target, one instrument.
Yeah.
Usually the target was inflation, and the instrument was adjusting the main policy interest rate. Keep inflation steady, job done. Kinda.
But then 2008 happened, Lehman Brothers, and that approach suddenly looked very limited.
Yeah, the limitations became starkly clear very quickly.
Yeah.
And the consensus shifted pretty rapidly on a global scale. Policymakers realized, okay, this one target, one instrument thing, not enough. They needed, as the thinking went, more targets and more instruments. The immediate problem was hitting the zero lower bound. You just couldn't cut interest rates any further, not meaningfully anyway.
Right. You run out of road with traditional tools.
Exactly. So that forced central banks into experimenting, into these unconventional policies. We heard a lot about quantitative easing, QE, basically large-scale asset purchases to get money flowing, and also targeted easing. Buying specific assets like those mortgage-backed securities in the U.S. back in 2008, 2009 to unblock specific markets that had seized up.
And this led to some really weird situations, right? Like that Alice in Wonderland liquidity trap idea.
Oh, absolutely. The upside-down world, you could call it, where interest rates are basically zero and people are just sitting on cash. In that scenario, counterintuitively, you actually want higher expected inflation.
Which sounds crazy. Why?
Because it's maybe the only way to get real interest rates. That's rates minus expected inflation to go down. And that's what might finally spur some demand, get people spending or investing again.
Wow. Okay. And forward guidance came out of this too.
Yes, exactly. Central banks started making explicit promises, saying, we'll keep short-term rates low for, say, 2 years, or until unemployment drops below X%, like the U.S. Fed did, linking it to 6.5% unemployment. It was about managing expectations.
So all this experimentation.
Yeah.
Did these new tools stick? Are they part of the standard toolkit now?
That's the million-dollar question, isn't it? I mean, some targeted easing definitely had a big impact when markets were broken, no doubt. But their effectiveness in normal times still debated a lot. But what's undeniable, I think, is the shift in objectives. Financial stability wasn't really the main focus before. It was kind of the junior partner to inflation control. Now it's front and center, arguably the single largest shift in central bank objectives because of the crisis. It's a primary goal.
Okay, so the bottom line for you listening, central banking isn't just about inflation anymore, not by a long shot. It's this complex balancing act. Managing prices, yes, but also watching out for bubbles, for systemic risks, trying to stop prudent risk-taking turning into that dangerous reaching for yield we see when rates stay low for too long. Now, when monetary policy hit that zero bound, governments had to step in big time, which brings us to fiscal policy.
Right. Initially, the response was massive fiscal stimulus, government spending, tax cuts, trying to plug the demand gap, stop a total collapse like the Great Depression.
But that didn't last forever, did it? The mood shifted.
No, it shifted pretty quickly. Once the immediate panic subsided, the focus turned to fiscal consolidation, cutting deficits, controlling debt, because public debt levels had just exploded, partly from the stimulus, sure, but also because tax revenues plummeted during the recession.
And this brought up that scary idea of debt becoming unsustainable, even if it didn't look that high initially.
Exactly, the concept of multiple equilibria. It suggests that even a debt level that seems okay can suddenly spiral if investors lose confidence. They demand higher interest rates, which makes the debt harder to pay, which makes them less confident. It's a vicious cycle, a bad equilibrium.
Is there a way out of that?
Well, look at the ECB in 2012. Mario Draghi's whatever it takes, their commitment to step in and buy Spanish and Italian bonds, it calmed markets, brought yields down dramatically, basically shifted them from that bad equilibrium to a better one, showed commitment can work.
But the debate over how effective government spending actually is,
Mhm.
that's still fierce, right? The fiscal multiplier.
Oh, absolutely. Huge debate. Take Roberto Perotti's research. He really pushed back against this idea of expansionary austerity, the notion that cutting spending during a slump can somehow boost growth.
That always sounded a bit odd.
Well, his findings show no real evidence for it in the short run. In fact, he argues it usually has negative effects on activity. He pointed to the austerity in places like Greece and Spain, the Euro periphery, as a big reason they had that double dip recession. So, yeah, very contested.
And historically, countries have dealt with big debts in other ways.
Sometimes, yes. You've had periods of rapid inflation, like the U.S. after World War II. Inflation basically eats away the real value of the debt. But, and this is crucial, that requires monetary policy to kind of serve the government's debt needs. That's fiscal dominance. And it's why central bank independence is seen as so vital today to prevent that.
What about things like unemployment benefits? Don't they help automatically?
They do. Those are automatic stabilizers. They kick in without new legislation. Very helpful. But they're probably unlikely to deliver the optimal cyclical fiscal policy response on their own. There's been talk about designing better stabilizers like investment tax credits that adjust with the cycle, but honestly, there's been little analytical exploration and essentially no operational uptake. Not much movement there.
So, the takeaway for you. When you hear debates about stimulus versus austerity, just remember how complex it is. The timing, the type of spending or cuts. It really matters. It can make the difference between recovery and deeper recession. And politics always gets in the way of the textbook solution, doesn't it? It's this constant balancing act.
Okay, so one really clear lesson you mentioned was that trouble can brew even when everything looks fine on the surface.
Yes. Dangerous imbalances can build beneath a seemingly tranquil macroeconomic surface. That was maybe the unambiguous lesson. Inflation might be stable, growth okay, but the financial system could be heading for a cliff.
And that led to this big focus on macroprudential instruments, the third leg.
Precisely. Intense interest. Because these tools are different. They're more targeted than just raising interest rates or cutting spending across the board. They aim right at preventing those systemic financial risks.
Like, what kind of tools are we talking about? Things like loan-to-value limits, LTVs, capping how much you can borrow against a house price? Or debt-to-income limits, DTIs, capping debt payments relative to income. Also, capital controls, though now often called capital flow management tools, regulating money flowing in and out of a country.
And do they work?
Well, look at Korea. Their use of LTVs and DTIs seems to have significantly reduced mortgage credit risk. Simulations suggested house prices could have been, 75% higher, and mortgage loans 137% higher by 2012 without them. That's a huge difference. Israel also used LTV limits quite actively to try and cool down its housing market when it got overheated.
And there's this idea about different cycles, right? Financial cycles being longer.
Yes, Claudio Borio's work highlights this. Business cycles may be up to 8 years, but financial cycles driven by credit, property prices, much longer, like 16 to 20 years. Risks can build up slowly over a long time under the radar.
Which makes them hard to spot, even with fancy tests.
Apparently so. Worryingly, those macro stress tests that banks and regulators run, simulating crises. Borio points out that none of them flashed red ahead of the recent crisis.
Wow. So they might create a false sense of security.
That's the concern, a potentially dangerous blind spot.
So these macroprudential tools sound good in theory, but what about putting them into practice? Are there challenges?
Big challenges. One finding is they seem more effective in strengthening the resilience, making the system tougher, than in constraining financial booms themselves.
Why is that?
Because capital is cheap and plentiful during booms. It's hard to stop the party when everyone wants to lend and borrow. Plus, there's regulatory arbitrage. People find ways around the rules. If banks have LTV limits, maybe lending shifts to less regulated shadow banks. Always happens.
And the politics must be tricky.
Extremely. The political economy problem. As they say, it is even harder to take away the punch bowl when the party gets going. These tools often have clear winners and losers, distributional effects. Imagine telling young families they need a bigger down payment because you're tightening LTV limits. That faces real political backlash.
So for you listening, macroprudential tools. They're a potentially powerful addition to the toolkit. Targeted, preventative, but making them work in the real world. That depends on getting the settings right, stopping people gaming the system, and crucially, having the political courage to use them when things seem good, not just after a crash. Okay, let's talk about the banks themselves, especially the huge ones. Too big to fail. That phrase was everywhere after 2008.
Painfully evident, yes. The idea that some financial firms are so large, so interconnected, that their failure would just cascade through the whole economy, governments felt they had to bail them out.
Which led to calls for a whole new approach to regulating them.
Definitely. And we have seen progress. Higher and more robust capital requirements. Banks have to hold more capital as a buffer. New liquidity requirements, too, making sure they have enough cash. In the U.S., Dodd-Frank created the Orderly Liquidation Authority, or OLA.
What's that supposed to do?
The idea is to have a mechanism to wind down a failing giant, a sci-fi, systemically important financial institution without a taxpayer bailout. Force losses onto shareholders and creditors instead. But, concerns remain. About spillovers, how failure still impacts others, and whether firms still have an incentive to stay big, complicated, and interconnected precisely because it makes them harder to let fail.
And this sparks that debate, how best to control size, price, or quantity.
Right. Drawing on Martin Weitzman's classic work, do you impose hard size caps, a quantity rule, or do you use capital requirements that increase with bank size, a price rule, like a progressive tax on being big?
What's the thinking there?
Well, former Fed Governor Jeremy Stein argued for the price-based approach. He felt it was more flexible. It lets bank managers weigh the cost of extra capital against the potential benefits of being bigger, like efficiencies of scale. Gives them a choice, sort of.
But not everyone agrees the current rules work well.
No. Former FDIC Chair Sheila Bair was famously critical of the risk weightings in the Basel capital rules. Her quote was something like, "Lending to IBM is viewed as 5 times riskier than lending to Morgan Stanley. How dumb is that?"
Point taken.
Yeah, she argued these rules were easily gamed before the crisis, letting banks hold less capital against supposedly safe assets that turned out not to be safe at all, undermined the whole point.
And besides capital, there were structural changes proposed too.
Yes. In the UK, they brought in ring fencing, separating basic retail banking from riskier investment banking within the same group, protect the essential stuff. In the US, the Volcker Rule aimed to stop banks doing proprietary trading, essentially gambling with their own money.
So different approaches.
Seemingly different, yes. But interestingly, some argue the UK and US are actually converging on structured universal banking, both ending up with systems where different banking functions are separated or treated differently, just arriving there from different directions.
So for you, the takeaway on too big to fail, lots of action, lots of new rules, but the debate on the best way to structure the financial system, the most effective regulations, it's far from over. It's constantly evolving. Let's pivot now. Exchange rates, another huge piece of the global puzzle. The crisis really hammered home some old lessons here, didn't it?
It really did, particularly how a flexible exchange rate can act as a crucial shock absorber.
How so?
Well, look at the contrast. Countries locked into fixed rates, like Spain in the euro area. Adjusting to the shock was incredibly painful. Deep, long recessions. They couldn't devalue their currency to become more competitive.
Whereas countries with floating rates.
Countries like the UK, Israel, Poland, Sweden, they benefited from the ability to have their exchange rate change. The currency could fall, making exports cheaper, imports more expensive, cushioning the blow from outside. The known weaknesses of the euro area before it launched, things like limited labor mobility between countries, no real system for fiscal transfers. These missing shock absorbers really became apparent during the crisis.
And this period saw a massive rethink on capital controls, right?
Yeah.
Something that used to be almost taboo.
A truly remarkable intellectual shift, yes. For decades, the standard view was that capital controls were bad, always and everywhere, just interfere with free markets.
But now,
they're seen, at least by many, including the IMF eventually, as potentially appropriate and even desirable in certain circumstances.
why the big change of heart?
Well, the crisis starkly showed how volatile gross capital flows can be, especially cross-border banking flows. Huge surges of money rushing in, then rushing out just as fast. These flows can destabilize exchange rates, fuel asset bubbles, cause credit booms and busts, really wreck macroeconomic and financial stability.
So countries started using them more actively.
Some did, yes. Brazil used taxes on financial inflows, the IOF tax, to try and curb short-term carry trades and stabilize their currency. Korea put caps on banks' foreign exchange derivative positions and introduced a levy on certain foreign liabilities. They're trying to manage the risks from currency and maturity mismatches on banks' balance sheets, basically, stop them borrowing too much short-term foreign money.
So for you, what this means is that how a country manages its exchange rate, fixed, floating, somewhere in between, and how it deals with capital flows, these are absolutely fundamental choices. They have huge implications for how resilient an economy is, how well it can handle the inevitable storms in the global financial system. It's not just technical stuff. It affects real economic outcomes. Okay, we have covered a lot of ground today. A really complex landscape. Central banks, governments, macroprudential tools, bank regulation, exchange rates.
We have, and I think the thread running through it all, as someone like Joseph Stiglitz would emphasize, is this fundamental relearning. Market economies, on their own, are not necessarily efficient, stable, or self-correcting. The crisis really poked holes in a lot of prevailing economic models. It showed that getting a quick recovery often needs strong government intervention. That was a tough pill to swallow for some.
And maybe the biggest blind spot of all was debt.
That's what Adair Turner argued very forcefully. A crucial blindness was related to debt, a widespread failure, really, to grasp how important aggregate leverage total debt levels actually was. These debt levels were largely absent from previous models. People just didn't focus on the stocks, only the flows.
And that led to?
It contributed to these deep balance sheet recessions, where everyone, households, companies, tries to pay down debt at the same time, which is rational individually, but collectively, it crushes demand. And often, the private debt just ends up shifting onto the government's balance sheet anyway.
Which leads to a pretty sobering thought for the future, doesn't it?
It does. David Romer expressed this fear quite well. He worried that the changes made so far, while significant, are still relatively modest, that they're unlikely to be enough to prevent future financial shocks from inflicting large economic harms. He called for a more fundamental rethinking of finance and macro policy altogether, something beyond just tweaking the existing framework.
So maybe a final thought for you to consider. If debt levels are that crucial, and if markets don't just fix themselves, what kind of truly radical reforms might actually be needed to prevent the next crisis? Reforms beyond what we've talked about today. And who, globally, needs to take responsibility for pushing those through, even if they're unpopular? Well, that's our deep dive for today. We hope it gave you some surprising insights, maybe a clearer view of this ongoing, incredibly complex effort to build a safe